Dr. Trader is back. Euro-US dollar is presenting a clean analytical contradiction this week. The macro argument favors a stronger dollar, but price structure has not confirmed a bearish trend. At the locked publication snapshot, the pair traded at 1.16676, only 6/10,000ths below weekly VWAP at 1.16682. That is roughly 6/10ths of a pip. Price is testing the level from underneath, so this is a decision zone rather than permission to chase either direction. The bearish argument begins with the United States. One-year consumer inflation expectations rose to 5.8%, while Boston Fed President Susan Collins indicated that policy may need to tighten soon if inflation does not moderate. U.S. real yields stand at 2.38%, and the Fed to ECB rate differential continues to favor the dollar. The transmission mechanism is straightforward. Firmer rate expectations support yields. Higher relative yields support dollar demand, and that places pressure on the euro-US dollar exchange rate. The intermarket check, however, refuses to give the bearish case a clean pass. The dollar index still carries a low-confidence bearish bias, while the euro-dollar technical structure remains bullish across the daily, weekly, and monthly timeframes. Recent U.S. data are also mixed. Consumer confidence and the Richmond Fed Manufacturing Index missed expectations, while new home sales were slightly stronger than forecast. Dollar-supportive inflation and Fed signals are therefore competing with softer growth indicators and a currency chart that still points higher. The price map contains two distinct levels with two different jobs. Weekly VWAP at 1.16682 controls the immediate momentum test. Price remains marginally below it and is probing from underneath. A rejection would give sellers short-term evidence, but a later session close over VWAP followed by a hold would add momentum against the bearish thesis. Weekly TrendSL at 1.15571 is the structural threshold. Price is approximately 110.5 pips above it, which means the weekly bullish structure remains intact. This is where a reasonable macro view can still become a poor trade. Selling immediately because the Fed sounds hawkish may identify the eventual direction but ignore the current market structure. Positioning adds another layer of risk. The available COT signal indicates that leveraged funds are heavily short while price continues to rise, a mismatch that can fuel a short covering squeeze. The source data do not include a confirmed report week or an exact net position figure, so that signal must remain directional evidence rather than a precise standalone statistic. The two scenarios should not be blurred together. Bearish structural confirmation requires a weekly close below TrendSL at 1.15571. Only then would technical structure align with the macro bias for the first time. The opposing path begins with acceptance above weekly VWAP at 1.16682, especially if the dollar index fails to recover. That would not automatically create a long signal, but it would make early bearish positioning increasingly difficult to defend. The practical conclusion is a medium conviction bearish bias with a decision to wait. Watch weekly VWAP, real yields, the dollar index, and the next U.S. data releases. Trade the conditions, not the label. Follow Intermarket Edge for the full market map and scenario updates. This analysis is for informational purposes only, offers no promise of returns, and is not individualized financial advice. Always manage your own exposure and risk.